Okay, guys, just wanted to come to you and talk to you about entities in general. When you're starting a business, you actually don't even need to do anything to have a form of a business. When you originally start a business, you starting as a sole proprietorship, whether or not you have filed that with the actual IRS or not, you are automatically a sole proprietorship. And so let's kind of talk about some of the things that's within a sole proprietorship. Well, a sole proprietorship is taxed just the same as really an LLC is, which I'll kind of talk to you about in a second. You typically, the majority of the time when you're rolling a sole proprietorship, you have to file something on your taxes that's called a Schedule C. And that will typically detail the expenses and the income that you have in that particular entity. The thing with sole proprietorships that from a tax standpoint that aren't really that great is that you have to pay self-employment taxes. And so those self-employment taxes could be 17% plus on that end, and that's monies that you'd have to pay. So let's just say hypothetically you end up making $100. Well, 17 of those dollars would be just specifically self-employment taxes. We're not talking about any other taxes but just that on that end. And there's other taxes and other things on that end. The beauty though is that when you have that business set up, and this is why I tell people, even if you have no entity form, you can end up counting all of your typical majority of your expenses towards and against that income. So let's just say you end up making $100,000, and that money flows down to you on a personal level, which sole proprietorships, LLCs, and Class S corporations, those other two I'll get on in a second, they all are what's considered flow-through entities. And what that essentially means is that all the income that comes in flows down to you on a personal level. So specifically in the sole proprietorship, so all income and or expenses flow down to you on a personal level. So let's just say you have additional expenses in your business, whether they be mileage expenses, or whether they be marketing expenses, or whether they be food expenses, or whatever the case is. Let's just say you have $80, $90, $100,000 in those expenses. You can still write those expenses against whatever income you have in your organization. And for a lot of you guys, if you don't actually have any income, you still can count those expenses against that, and you could have certain losses that you can end up potentially in getting a lot of the money that you spent in your business back. So I typically tell that to people, and if some of you guys have other credits like earned income credit, or you have other tax credits that you have, by starting that business, you could actually get a lot of the money that you put in that business back initially. And there's certain things when you first start up a business that you can get deductions for. But the downside outside of the self-employment tax from starting a sole proprietorship is that you really have no liability protection. What does that mean? So it means that if somebody was to come sue you, if somebody was to come and slip and fall in your business, whatever the case is, there's really no layer that separates you from the business. Anything that happens in that business, you're liable for. And if they were to, from a liability standpoint, want to sue you, then they could essentially come after you personally for damages, because there's really no other layer for them to go against. So the liability is something that you see that's the liability protection, or the lack thereof, is something that you see in a sole proprietorship that you don't have in typically other entities. But when it comes to the tax liability, as I'll start talking about later in those other entities, I'll show you too how, although you may be protected from in these other entities, LLCs and S corporations, with liability protection from other people come and sue you, you still have tax liability that you have there, which I'll kind of talk to in a second. But that's just a real overview of really what a sole proprietorship is. That's, you can file that once again with the IRS, but you can still be a sole proprietorship without ever even filing something directly with the IRS. You just have it kind of by default when you're starting a business. So that's really the gist of a sole proprietorship. I'll kind of get on and talk about an LLC in a second. All right, the next most popular entity that you would, most of us would know of is a LLC. It's a limited liability company. It is not a limited liability corporation. And I hear a lot of people, they'll say that, oh, I have a limited liability corporation. Well, it's not a corporation. Actually, corporations, as I'll talk to about later, have started literally hundreds of years ago. Even really before the founding of this country, you had corporations. Now, limited liability companies are a fairly new type of entity structure. They were formed maybe 50 years ago. What they did was kind of combine the protection of a corporation with the combination of a partnership together. So it gives you liability protection, as I mentioned in the previous video, that through a sole proprietorship, you will not have that liability protection. You can't, if someone comes to sue you or something happens in your business, you're a hairstylist and somebody's hair falls out and they want to come after you, they could come after you and your personal assets and all your personal belongings. But with this actual a line that you set in the sand, per se, with this limited liability company, it sets up a separation between you and the actual business. And so this limited liability company was set up in that way. I see a lot of people doing LLCs, and when probably a lot of people probably should not be doing LLCs. And it's just because I think they go in it not understanding what it is, or not are fully even understanding what it is not. And so when as I mentioned before, this is not a corporation. Okay, so although you do have the protection, that limited liability protection, if someone is coming to sue you, they couldn't come after your personal assets. There's still a line that's drawn between what you can protect with an LLC and what you can protect with a corporation or a full-blown Class C corporation. So in this limited liability company, though, you could start this up and have that protection on that end, but because it's a flow-through entity, okay, just like a sole proprietorship and just like an S corporation, all of the income and all the expenses flow down to you on a personal level. And this is so important. You say, JR, why is this important? Because let's just say you end up not paying taxes for a few years, okay? And when you go to pay taxes, if you had some income or whatever that was just sitting in there that you made, and so taxes were due and you had not actually done anything, that actually can flow to you down. And regardless if you start or stop the business, you would still be responsible for those taxes. And so in addition to that, because it is a traditional limited liability company, it's considered a disadvantaged entity, okay, or a disregarded entity, better yet, a disregarded entity. And what does a disregarded entity mean? Well, it means that essentially the IRS doesn't recognize it as an entity. Your state may recognize it as an entity, but the IRS doesn't. They just still see you as the person responsible. So let's just say you set this up. They say, well, look, we don't care. We just see JR. Okay, we don't see 123 LLC. We see JR, and you're this person that needs to be held accountable for paying these taxes. Okay, and so the IRS does not see a difference between an LLC paying taxes and you paying taxes. So there's no difference in their eyes. Okay, now, from the Secretary of State, typically in your state, they will show some kind of a difference there. But when it comes to taxes, there's no difference in paying taxes with an LLC as it is with a sole proprietorship, or nothing. Okay, so there's no tax benefits really at all to starting a LLC outside of what you would already traditionally have just by not having anything or having that traditional Schedule C or sole proprietorship. There's no benefit in that way. And so there's some benefits to the LLCs that happen later. What I typically utilize LLCs for are different things and for different reasons. For example, I may have two entities that I have. I may have two entities that I want to come together with somebody and do a business together. Okay, but I don't want to actually come in and form an actual full company with them. I could say, okay, ABC Corporation and 123 Corporation want to come together and do this particular business together. We'll join that together and form an LLC. So both of us will have ownership into that particular LLC, and we'll go and start doing business together in that LLC, okay? And we'll make things happen and do things on that end. And the LLC will be the actual entity that will be doing business with the actual customer. It will not be 123 Corporation or ABC Corporation. It will actually be, let's just say, 456 LLC, okay? And so, and so let's just say we did business, any of the expenses and or income flowed back up to me, meaning that we were responsible for those pieces on that end. But let's just say, hey, it's a year or two later, we don't want to do this anymore. Okay, cool. We can actually exit. And then we're good. We don't have to. It's just we stop doing that LLC together and we continue to roll. That's what I typically would utilize LLCs for. A second thing that I would use it for is if I had an actual real estate property and I was going and putting getting a piece of real estate, and I had a management company, and I didn't want, I wanted to have, limit my liability. I would set up a separate LLC for that actual house that I was renting, okay, and in that LLC would be separate and distinct from my parent company, so it's giving me layers of protection there, and so that's another reason. So I would say that I would have a LLC, but outside of that, typically I don't. That's not a preference for me as an entity. I'll go on and kind of talk about some other entities that make more sense. Now, I will say this: there are exceptions to getting taxed like an S-Corp. I mean, like a sole proprietorship in that LLC, but you have to get an election, and it has to be approved by the IRS. And IRS subchapter S election that you can have on the LLC, okay, to where it can be taxed like an S corporation, okay, but you have to, and in that case, you do not have to pay self-employment taxes, okay, but in that case, if you do not have to pay those self-employment taxes, okay, then you do have to set yourself up to pay yourself personally what's considered a reasonable salary. So let's just say you say, what is a reasonable salary? That depends on the business. That it depends on a lot. But essentially, the IRS is saying, hey, you can avoid these self-employment taxes, but you have to pay yourself something. And it has to be a reasonable salary to what you're making, okay, what the business is making. And then in that, and then only that, so that still means you still got to pay payroll and all those things. You still have to have all those pieces set up. But in that case, if you do all of that, then you can avoid paying that almost 17% in self-employment tax there. And so those are some things that you can do with a traditional LLC. But for the most part, LLCs are just like having somewhat a layer of protection between you and the people that you're actually serving, so that if anything happens, in case that it does happen, you are protected from them coming after your personal assets on that end. And so, but for the most part, that's all that you get with that unlimited liability company. No tax benefits. You do get that layer of protection. And there are things that you can use it with when you get a little bit more advanced. If you're a company out there that's looking, you're making profits and you have a corporation, you're looking to make profits, or you have an entity that has shareholders and you're looking to do certain things, you can use LLCs for certain things to avoid being taxed twice when it comes to how you're actually distributing things. But that's in the future. That's a little bit more advanced. That's not something that we want to really cover today. But that should be it, guys. Y'all take this information, go and apply it, and good luck to you.
So let's say I wanted to start an online business, but I don't even know the first thing about web development or anything, like at all. What should be my first steps? And like, do I need to be a sole proprietor like immediately, or get an LLC immediately? Like, do I need to worry about taxes right off the bat? What's the first things that you recommend we should do?
No, I think you should just get started. Don't do anything. Don't try to. I think a lot of people get caught up in trying to do all of that stuff first. And then it takes off the momentum of you actually doing the thing. So what you want to do is just go and just do it. And then, like I said, because, let's just say at the end of the year, the end of the month or whatever, you end up making money. The IRS does not care. They just want to see what money you made, and they're going to tax you on that money that you made. And if you had expenses, okay, it doesn't matter. You can still, once again, through an LLC or through a sole proprietorship or whatever, you can still take your expenses with filing nothing and on a Schedule C and write that off on your taxes. So it's a lot of people that have, I got my LLC in place, I got all this stuff in place. I say, you made any money? Not yet. And so, but that's the thing. So the opposite thing that we should be doing is trying to figure out those things. That's later. You do want to focus on that, but that's not a priority, because if you're never making any money, it may always forever be a hobby. So you want to get to making money as fast as possible. Once you made that money, then that's when you want to start thinking about, okay, I've made the money. Now let's start figuring out, like, hey, how can I have any particular savings here? Now, if you get along the lines to where something is, you say, hey, after month one, I made some money, then yeah, okay, maybe I need to start looking at that then. But the biggest thing is just get it going. Start getting customers. That is the number one thing that you should do. How can I get customers the fastest? And then figure out everything else later.
Okay. Could I use the money that I used to start up the website, right? Say I pay somebody to build me a website. Could I use that as a tax write-off?
Totally. All of that money, and I love to do that. Like, all of the money that you spend on your website, any money that you spend on your logo, any money that you spend buying anything for the business, gas that you're spending, mileage that you're spending on your car to go do something for the business, all of those things can be written off. So, I've seen a lot of people be in really good positions and they haven't really even made any real money in their business, but because they had their expenses, they're able to count that stuff against their taxable income, which is a really good thing. So I always tell people, keep those receipts. Even if you don't have receipts, though, if you can show through your bank account, you just have to go through there and line that out, and show these are my expenses that I have. Even on credit cards, a lot of people, you may have expenses on credit cards. That's fine. You just need to be able to track where you can show and prove that, yeah, this is what I spent here on this credit card, right? And so as long as you can prove that and show where these expenses are, you should be good. But I'd say, get as many expenses as you can. I tell people all the time, and I always typically try to look at things that say, hey, you know what? How can I spend money on something that I can write off? That's I'm always thinking is like, hey, can this be something that I can, that I may be able to, maybe if not 100% of it is deducted, but some of it can be. And so, and I really don't even try to make purchases unless that's something that I can make happen on that end. For the most part, now you have some things you just have to buy, but I try to look at things, okay, how can I utilize, when I'm taking my money that I'm spending, I'm looking at how can I utilize some of these things in the operations of my business on this end. And that's what I look at. So even with, like I said, people got houses, they have houses and they have a portion of their house that they're using to do things in business with. Well, all you need to do is say, hey, this is the portion that I'm using for my business. You take the percentage of how much you're paying, and that's a percentage of what you can write off on your taxes. Like, this percentage of my house I use to run my business through, right? And so a portion of that can be written off. And you need to talk to a good accountant to make sure that, you know, when you're doing that they have it itemized and set up right in the system. But yet all of that can be written off. And that's what I would advise people to do as much as possible. Now, this next entity, well, first off, let me go back a little bit and kind of talk about the LLC. And one thing that's important that I didn't speak about in the LLC that I think you need to know is that when you have an LLC, if you're trying to, you should say, raise money, trying to go out and do a tech company or trying to raise venture capital money, if you have an LLC, you're not going to be able to raise money. I'm just telling you that right now. If you're trying to go out and raise money, even if you got a project essentially that you're saying, hey, I'm trying to start a film, and you have an LLC, you're not going to be able to raise money through that entity at least. Okay, why? Because there is nothing to own. There's not. So put it like this: in an LLC, you do not have a they're not shares. You have articles of organization. And so you don't have shares in that entity. Okay, so let's just say that somebody gave you money. Okay, well, what they would essentially have to become a part of that entity. Okay, and so they would have to wait for you to see your expenses and income before they can even file their taxes. So if I'm an investor and I'm looking at investing in your business and you have an LLC, I'm either not going to invest in the business, or I'm going to make you convert that into a corporation so that I can have shares and share certificates that I could actually get on that end. In addition, one thing you need to also understand about an LLC, let's just say you had a multi-member, you started an LLC with your brother or your cousin or whatever, and they decide to leave the company, you're supposed to stop that LLC. Okay, because when somebody exits that company, that LLC is really not supposed to even exist after that point. So it is, and LLCs are what's not perpetual. So what does that mean? That means that they do not continue to go. Corporations, you can start a corporation, it can go on indefinitely. But LLCs are supposed to have a start date and an end date, okay? In addition to that, with the LLC that I didn't mention before, is you have to have something that's called an operating agreement. And if you don't have an operating agreement, it's supposed to say what that LLC is supposed to do, what is not going to do, who's in the entity, how long the entity is supposed to last, when is the start date, end date, all these pieces on this end. All of these things would go inside of an operating agreement. And if you don't have that, then the entity is not really set up correctly. And this is why I say 99% of all limited liability companies, well, maybe 97%, okay? Especially for people that don't go through regular forming companies or lawyers that know what they're doing, okay? And I have to phrase that because you could have people who don't understand that either, but you need to have an operating agreement for your limited liability company to have it fully be a true and credible limited liability company. So if you don't have that, if you don't pay your annual registration, okay, then that entity will not be credible and viable. So if somebody was coming to sue you, they could essentially get past that liability protection to actually seizing your personal assets on that end. And so that would be something I want to say there. So that's on the LLC. Now, going on to the S corporation. As I mentioned before in the LLC portion, an S corporation, you can, as a LLC, get an election to be taxed like an S corporation. But that doesn't mean you are an S corporation. That means just the IRS will allow you to have a S corporation election and be taxed like that, right? S corporations are different. Okay, S corporations, they have a limited. They are a corporation. Okay, and so that is recognized by the state and recognized by the IRS as a particular specific entity, not a disregarded entity like the LLC is. Now, the difference in that S corporation is that you cannot have an unlimited amount of shares in that S corporation. You can have it's a smaller amount of shares that you can have. Okay, that's one thing. In addition, the second thing is that through that S corporation, all the income and/or expenses will flow down. Once again, it's a flow-through entity flowing down to you on a personal level. So that's a good thing in certain cases, especially for certain people that they may be on jobs, they are making income on a job, and they need additional expenses to count against the taxes that they'll be paying on their jobs. That income works good through that, going through that. I mean, those expenses work good going against that income that you're making on your job. So if you own a job and you say, hey, I'm on a job, JR, what's the best entity for me? This is something you need to discuss with somebody individually. We could kind of look and see everything to kind of see what you need to have specifically. But I would say this, if you're on a job and you want to count your expenses against your taxable income that you have on your job, and without having to have those particulars, the self-employment tax and all those pieces, sometimes that Class S corporation can be a good option. As I mentioned before, too, if you have a C corporation and you have an entity and you're looking at, you have profits that you have in the company and you're looking at how you want to distribute them, sometimes the S corporation would be a better option to utilize if you're doing a lot of distributions on that end. But S corporations, once again, you don't have to pay that self-employment tax that you would be able to, that you would have to pay in a LLC traditionally. And in addition, you can still have shares that you can issue. There's a limited amount of shares or stocks that you can issue, but you still can issue those things on that end. And so in certain investor classes, that may be a good option for you on that end. So that's what an S corporation is. So typically, people that are on jobs, flow-through entities work good for them, but it's still, in my opinion, a lesser entity, for what I typically do and what most businesses do when you really are going to start making money, and that is the Class C corporation, and we'll get into that in a second. All right, now this last entity is one of my favorite entities. I love this entity. It is the only truly separate entity that exists. All other entities are kind of closely tied to you, like kind of close to your person. They're kind of like really you, and it's kind of like intertwined together. This entity is really the only entity that's a truly separate entity. As a matter of fact, certain people, in a lot of cases, you'll hear this talked about as an invisible person. It has its own tax. It's set up separately on that end, and that is a Class C corporation. So let's talk about some things about the Class C corporation and the reason that I love it. I love it for a lot of reasons, but if you're looking at raising capital, first and foremost, this is the entity that you want to use. Some people will use a Delaware corporation or Nevada corporation. But I would just say, for the most part, most of you guys just use the corporations that are in your state. Those are more than capable to do what majority of you all are looking to do. But I would say this, that a Class C corporation is a truly separate entity. Now you can issue all types of shares. You can issue stocks, preferred stocks, common stocks, and that's just essentially without complicating it for you. One just shows if anything ever happens to the company, who's going to get paid out first, right? Let's just say the company goes out of business. And so there's investors that put money in the company. They're like, hey, well, they still have assets. They can sell off these assets to pay off some of the debts or to pay back some of these investors. So the preferred or the common essentially will let you know who gets paid off first, okay? And so there's a much more to it, but just for simplistic purposes, that's what I would say there. So you get stocks. So if somebody's trying to invest in your company, they're going to want you to essentially be a Class C corporation, because this then will, if anything ever happens to one of the owners of the entity, the entity can keep going on, and there is a separate, there's separate ownership specifically in that entity that does not matter about the people that are actually running the entity per se, right? So they still are able to be protected in their investments and the business can still continue to go on regardless of really what happens to the people that are per se operating it. So that's one thing. So from an investor standpoint, you want to have that. Number two, it is from a tax standpoint and from a liability standpoint, is the only entity that truly separates you from everything else. So the IRS, as a matter of fact, when you call into the IRS about that C corporation, they're going to say, hey, are you an officer, are you somebody that can speak on behalf of the entity, right? And because they're not looking at this as like JR's entity. They're looking at it like this is the entity. Now, JR may be somebody that can speak on behalf of the entity, but it is an entity. It has its own taxes. It can go out, be sued, and it can go out and even have babies because it can have other entities up under it, right? And so you see people that have holding companies. Typically, you have a Class C corporation that will be a holding company that would manage other entities. So this, in the IRS's eyes, this is a truly separate entity that's separate from all of these other entities that you would see. That is phenomenal when it comes to, so let's just say you make $1 million in that entity, right? But let's just say you did not pay yourself anything personally. Well, the entity is responsible for that. You would not necessarily be responsible for that, even though there are some things you don't want to do, fraud and all this kind of stuff on this end, but essentially the entity is responsible for that income and or expenses on that end, okay? And so it is separate from your personal things on that end. Now, what you'll see in a lot of corporations is that they may have even paid out people. They may have gotten paid. They may have paid all their employees. So you look at a lot of these tech startups, you see for like 10, 20 years, they did not make a profit. And you say, well, how are they able to do that? So does that mean that they didn't make any money? No, that doesn't mean that they didn't make any money. It just means that they did not take any actual profit out after expenses to end up paying to shareholders or whoever, right? So that means they could have made $10 million that year and could have expensed $10 million that year and not have any taxable income on that end. And so there's a lot of other things that, are in there, but just for simplistic purposes, let's just keep it there. Now, what I also say is other benefits too. Like, you'll see, and let's just stay along those lines for big entities per se. Let's just say that somebody's saying, hey, you know what? I'm not going to take any money in a salary. I'm gonna just take $1 salary, okay? But then that same corporation takes $100,000 in fringe benefits, okay? And you say, well, what is that, JR? Well, these are benefits that they can take. It may be something like life insurance, health insurance. It could be something like longevity plans, which I get on those later. But all of these are different expenses that can be counted against the corporation's income. So let's just say the corporation ended up having $100,000 in additional income, and it paid one of their executives $100,000 in fringe benefits. Majority of those fringe benefits, if not all of them, are 100% write-off against the entity. Okay, so it can write off that against his taxes, but the actual person that took the fringe benefits, they don't have to claim that as personal income. Okay, so they could have. So you say somebody, they only took $1 salary. So they're so noble. Yeah, but they took $100,000 in fringe benefits or $200,000 in fringe benefits. And those were things that they did not have to count under their personal income. And so I'm bringing those things up just to say that, you need to make sure, once again, you get with somebody that understands those things. But this is in the tax code. These are things that currently exist within the current tax code that you can do when it comes to setting up Class C corporations. You can set up yourself for fringe benefits. These are additional benefits that you can have as an officer in an organization or as a individual in the organization without having to pay taxes on that personally. Now, in addition to that, there's other things like fiscal years. Like, so for example, a lot of our companies in the end of July. So that means 2.5 months later, our taxes are due. Okay. So, traditionally with all other entities, you have to have a December 31st year end. So that means that your taxes will be due sometime in March or in April, right? But not the case with a Class C corporation. You can set up that entity to be due at any time of the year, okay? And why does that make sense? Because it gives you greater tax flexibility between anything that you have to pay personally and any other entities that you have. So it gives you that greater tax flexibility on that end. And in addition to, when you're going to banks and a sort, typically most banks look more favorably to lending to Class C corporations. And so, and then, you know, from a liability standpoint, hey, this is a truly separate entity. Okay, so it's not close to the vest on you. It's truly separate. There's a lot of benefits to it. Now, there are some per se disadvantages, and I do that with air quotes because if you know what you're doing, these don't have to be disadvantages. Some disadvantages, people say double taxation, right? Well, or when and typically most of the time in these entities, what you'll see is that most of the time there is no profit in the first couple years anyway, so there's nothing to tax on that end anyway. But if you do have profit and show those things, yes, you do have to pay those taxes on the corporate level. And when you actually pay them out in dividends or into returns to the shareholders, they have to then pay that also. But let me tell you something, that's a good problem to have. If I'm making profit, I'm willing to make that things happen. There's ways to end up also reducing that down, which we can get on at a future date. But all I'm just saying is the Class C corporation is an entity that I typically go to the majority of the time. But sometimes that may not make sense for people. If you're not trying to grow a scalable company, if you have not made any revenue in your business, if you made little amounts of revenue in your business, right? You know, these may not be options for you at that stage of the game. One thing I do love is mesh strategies, which are multiple entity strategies. I like to use all of them because all of them have advantages and disadvantages to them, and that's something that we could probably talk about in a future video. But hopefully that helps, guys. Good luck.